extended deadlines. So, if you have no question, then we should continue our journey in the field of monetary policy. After last week, we started with the potential objectives, and practically we highlighted that. Okay, the alternatives are foreign exchange rate targeting, or it can be monetary aggregate targeting, or it can be inflation targeting. And at the end of the day, what we were able to see, at least from the historical perspective, that nowadays central banks are at least trying to focus on inflation targeting because it mostly suits well for their interests. But to achieve any kind of objectives, we need to define the set of instruments, because until then we were just talking about interest rates, but that's all. So we need to fine-tune this issue. So first of all, we have some nice principles or rules. So first of all, there is the Tinbergen principle, which says that, okay, if we are targeting something, so it doesn't matter that this is the exchange rate, this is the inflation or monetary aggregate, but we need a specified key instrument which will help to achieve this targeted variable. So that's why for exchange rate is quite simple, because we can focus also on the interest rate. Just in this case, we are fine-tuning the interest rate parity. And also in the case of inflation, we have the key policy rate. So if we are changing this key instrument, then this will send a message to market participants and everybody in the economy that central bank aims something. And this is the biggest weakness for monetary aggregate targeting, because in that case we have multiple assets, and so we can set the mandatory reserves, we can set also the interest rate, so we can fine-tune many things, but we don't have a key policy instrument as the interest rate in all the other cases. So if we have one target, we should have one instrument at least. Also, during the 70s or late 70s, people realized that interest rate is much better as a tool than money supply, because in the modern economy, where most of the money in circulation is not cash or coinage, central banks can't have much impact on money supply at the end of the day. So this is what they were trying to do under monetary aggregate targeting, but yeah, interest rate is better because interest rate is part of not just for the whole yield curve, but it's part of lending, it's part of any securities operations. So that's why Poole was a researcher at the US Fed, and they were checking many different regimes, and at the end of the day, when they were running this analysis, then they were saying that, okay, interest rate is better tool. Okay, then after that, if we are going to the early 2010s, we can see that Taylor and Williams still verify this. So it was not just valid during the 70s, but also we can say that even in current modern times, because also it has much better impact on inflation and output, so we can use better. But obviously, we have not just large and robust economies, but also we have open and small economies. So Hoffman and Kempa went through all these issues from different point of views. So for large economies, they were able to verify that, okay, interest rate is good under liquidity shock. So if liquidity changes, so there is a scarcity in liquidity or there is excess liquidity, if we are setting the interest rate, then we can add necessary liquidity or we can remove the excess liquidity. But if there is a demand shock, the problem will be that in this case, the mass of, or the, sorry, not the mass, but the ability to acquire long-term loans to maintain the aggregate demand or to increase the aggregate demand, or also the ability to issue new securities, also to improve the demand on the market, this will be really weak. So in this case, interest rate policy will be, or interest rate instruments will be weak at the end of the day. So in this case, they are suggesting money supply as a tool, but this will mean that that you should, or as a central bank, you should use your balance sheet. So much higher activity at the asset side of the balance sheet will be required under demand shock. So that was the conclusion in this paper. For open and small economy, we can say that money supply rule performs better under a foreign liquidity shock. So if we are importing capital and then some liquidity shock happens, obviously central bank, so it will be not enough just to set the key policy rate, we have to do something else. So we have to buy domestic assets, we have to sell foreign assets, so we have to do something again at the asset side of the balance sheet of the central bank. Interest rate rule is preferred under foreign real shock. So yes, if output is dropping in foreign economies, then still we can stimulate somehow the economy, or we can stabilize the inflation. Foreign demand shocks are better absorbed under dirty floating. So they provided also some instructions about foreign exchange rate regimes. So they are saying that so if something wrong is happening in case of the German market, if we are talking about countries around the Eurozone, then it's much better if we are using dirty floating or some kind of a floating regime, which is a bit fine-tuned by the central bank if necessary, because some of this will be absorbed by the depreciation of our currency. Foreign supply shocks are cushioned much more under fixed exchange rate regime. So if something is happening within the supply side, so practically supply chain, or we can think about this one. Okay, and the last one about the famous rules is Goodhart law, and this is a key problem. So unfortunately, if central banks were trying to focus on one statistical regularity, so when they were trying to focus that, okay, there is a relationship between output and inflation and amount of money. So M2 and M1 monetary aggregates. The problem was that once they started to focus on this, or try to exploit this functional relationship, then it started to collapse. So that's why it's much better to focus on indirect targets. So that's why inflation targeting is much better supported. Yeah. And now let's see how can we support this. So according to the ECB, in 2013 or 12, one of them, so in one of these years, they published their handbook about the monetary policy, and in this case it was before the unconventional monetary policy introduction, because I will have a specialized chapter for unconventional monetary policies. So right now, in this case, we can see that how central bank tries to affect or influence the inflation or anything in the what it targets in the macroeconomy. So in their special case, we can say that how monetary policy decisions are affecting the economy in general and the price level in particular, because they are focusing on inflation. And but the key important thing here is that we have to understand that how shocks are happening, how shocks are affecting the different variables, how shocks from the external economy, how shocks from the economy itself will go through the economy. And that's why when they are designing the monetary policy decisions and their impacts, they have to consider all these problems. So they defined three main channels, or three relevant channels. Different books are defining different number of channels, but we are always finding these three most important channels. So that's why I'm just focusing on these three. So first of all, interest rate channel. In this case, it said that if we are setting the official interest rate, then it will have an impact on interbank market rates. So on short run, liability costs for the whole banking system, and after that it will go, or it will affect their lending rates as well. So all the long run asset interest rates will be affected. Also, similarly, we can say that, okay, if we are setting short-term interest rates, it will, or it should have, sooner or later, some kind of an impact on security yields. So it will affect government bond yields, and through risk premiums, it will affect also corporate bond yields. It should impact securitized loan interest rates. So at the end of the day, the whole yield curve should react. The question, obviously, the speed, and also what happens if we are just setting the interest rate on the short run, and then because of higher risk aversion, so because participants are afraid of partner risk, it doesn't have an impact or stimulating impact on long run interest rates and yields. So in this case, they are assuming that it will have whole impact, but the problem is that when market segmentation happens, then this interest rate channel can have really poor transmission. So this will be the story behind all the unconventional monetary policy instruments, because this main channel started to become really weak after 2008. Other one is exchange rate channel. So when we are setting it, when we are setting the interest rate, it will have an impact on the exchange rate as well, because of the uncovered interest rate parity in real term, and after that, because of we are importing goods and services, then imported prices will have an impact on the inflation, and at the end of the day, this will have an impact on the general inflation itself. Also, expectation channel. So if we have a credible central bank, so people are believing that if they are setting their interest rates, then they would like to do something, then it will already change the behavior of the economic actors. So if we can see that central bank starts to increase the key policy rate, then households will increase their saving behavior. So the excessive demand from the market will disappear, because they will focusing much more, instead of consumption, they are focusing on saving. And that's why we can influence the actors much better. This is a nice expectation. What we can see here that in impulse response functions, in vector regression models, in this case we can see that maybe not immediately, but on medium run, the impact of the shock from the variable in the specific case will have a long-term significant impact on the rest of the variables. I will show you later on examples like this. So these are the main or three most important transmission channels, how central banks are trying to have an impact. So if you are focusing on the graphical representation here, then we can see that yes, we should have impact on inflation and practically inflation expectations on the medium run, so during the next 1 to 2 years. And we should have an impact on consumer prices, so not production prices or nothing else, just consumer prices, because practically this is the most efficient way. So we don't have better benchmark. People tested it, and CPI is still not perfect, but right now this is the best what we have. Maybe 10 years later, in the future, someone will find a better solution, but right now this is what we have, because at least this is a good indicator to describe the balance between aggregated demand, aggregated supply, so we can see that what is happening with consumption, what is happening with savings and investments. Okay, this is not perfect, just it doesn't have better framework right now. Obviously, all of this will be affected by the conditions how private sector can take up loans or they can issue bonds, because their conditions are linked to do this to the secondary market of their assets. So if they can use their real estates or their other assets as collateral to take up loans or to issue the bonds, then obviously they can do it easier, with lower interest rates, and this is again expectations about how can they do it, how stable the markets, secondary markets of these assets, expectations about this thing as well. And after that, if we are just writing up the yield curve in the usual way, so we have the maturity, we have the interest rates or yields, then we can see that private sector will obviously take up loans with different interest rates because of their different partner risk levels. So probability of defaults will be different for different clients. Also the quality of the underlying collateral, the stability of the collaterals, secondary market. So many things will affect this one. So we have infinite amount of lines there, but the basic benchmark will be government bonds. So you should pay more than the government, because government is the strongest participant in the economy, because they are setting the rules. Then, if you are focusing on a commercial bank, then obviously we can say that yes, but everything here on the asset side is determined by the long component of the yield curve. So they are purchasing or they are allocating long-term loans, obviously to private sector clients. They are purchasing a portfolio of short-term government bonds and long-term government bonds, so it depends on the behavior of the treasury and what is preferred by the bank. And also, at the same time, on the liability side, we can find deposit rates. We can find also bonds which can be issued by the bank, so it should be also somewhere here. Just I did not want to overcomplicate things. And of course, the central bank will try to balance this out. Also, first of all, they try to balance this out if there is any scarcity on the asset or on the liability side. So if there is excess money or money scarcity, then they are going first on the interbank market. And if this is not enough, then they can go also to the central bank to get or maintain their balance sheet. So central banks will try to have an impact on the overall balance of the commercial banks with their deposit collections and also lendings to the commercial banks. And they are doing this on the short run. So usually they are providing 2 week, 1 week, overnight loans to the commercial banks. And otherwise not much, at least under mainstream rules. And of course, when they are doing it unintentionally, they will affect also the exchange rate, because the currency channel will be affected by the differences between domestic and foreign interest rates, so that's why they can have an impact. And after that, through import product prices and services prices, they will have an impact on consumption and then inflation itself. So this is a really simple process. So you can just imagine the whole economy and the whole financial system behind that, and also the central bank. So yeah. And asset prices. Okay. Cute. Because at the end of the day, if we are changing the interest rates here, the problem will be that asset prices will also fluctuate. This is also an unintended consequence. Because obviously, if you are thinking about any valuation method, then valuation is always related to the amount of money which can be generated by the specific corporate asset or even financial asset in the future. So when we have to determine its value, the present value of these cash flows, we need some kind of an interest rate to do that. And obviously, if these interest rates are changing, then if they are increasing, so the yield curve increases, then asset prices will decrease because we are dividing with bigger numbers. If interest rates are decreasing, then asset prices will increase because we are dividing with lower numbers. So at the end of the day, the problem can be that if we are cutting down the interest rates because we have a significant demand shock, then we can create a nice asset bubble. Because if we are decreasing the interest rates close to zero, because we would like to stabilize, we would like to increase risk-taking, we would like to stimulate the loan allocation, the issuance of bonds to stabilize consumption and investments, then the problem will be that also unintentionally we will increase asset price value. So real estate bubble can be created, we can create nice stock market rallies. So all these assets will have an increasing value, even without any implications from inflation or any other thing. Unfortunately, this thing naturally happens. So that's the reason why there is a growing economy for the welfare effect of the monetary policy, which is nowadays much more popular than it was 20 years ago. 20 years ago it was marginal, or I can't say non-existent, but during the last 20 years we can see that a lot of people were writing papers about it, that how can central banks focus on this? Should they focus on this, or yeah. I had a thesis worker, now she works at the central bank, and in her thesis we were analyzing that can we use the stock market index as an indicator for the output in the economy, output expectations, because stock market indices, obviously they are aggregating company or corporate stock prices, and these corporate stock prices should represent what we can expect as cash flows in the future. So at the end of the day, this is absolutely a forward-looking indicator, so it's much better than what we can use as GDP, unemployment, or manufacturing index. And we were able to say that, okay, at least at the level of a master thesis, she was able to prove that, yeah, we can describe it as an efficient variable. But later on I will talk about this. Okay, so what kind of instruments can we have? First of all, we have always a key policy interest rate. So for the ECB, this is the 1 week repo rate. Sometimes central banks have 2 week interest rate. This can be a deposit rate. This can be, in some cases, it can be even a bond which is issued by the central bank, and it can be purchased only by the commercial bank. Doesn't matter, but you should remember that short term, so less than a month, so ultra short term maturities where they are doing this. Okay, the ECB is preferring this repo, which means that they are defining a list of acceptable securities. These are government bonds in most of the cases, or other specific low risk and liquid bonds. Mostly these are government bonds. And they are saying that, okay, if the bank needs liquidity, then we can sell, we can buy this bond at a specific price. But within 1 week, this bank should purchase this back at a set higher price. And obviously the difference between the purchasing price and the repurchasing price will be the difference, and it will determine the interest rate of this securitized loan. So what we can see here that in this case, repos are always covered with a collateral because you are buying a bond, and if the bank doesn't have the money to repurchase it back, still you can keep this bond at the end of the day. So you can mitigate any partner risk in this case. So it's not so risky if you are just providing a loan to someone because this is securitized. And for example, in the case of the Swiss National Bank, they are focusing on the 1 month interbank market interest rate, which is way more crazier than this one. So in case of the Hungarian Central Bank, they just have a 2-week asset, but when I started my career, they were always jumping back and forth between deposit interest rate at the central bank, or sometimes they were issuing bonds, and in this case the bond interest rate was the key indicator. So it's really funny that sometimes they had this, that, so they are just playing ping pong with their main instrument. In case of the ECB, this is absolutely stable. And also they can have longer term refinancing operations when they are just extending the maturity of this repo until 3 months. Also, they can have fine-tuning operations when you can see that there are some shocks, so you are using multiple instruments to mitigate this one. So they can be purchasing government bonds, selling government bonds, doing foreign exchange swaps, and fixed-term deposit collection can happen. Later we will have a whole class about foreign exchange swaps because they have also a special purpose. But next thing, what is relevant, standing facility. So in this case, I'm talking about this overnight part. So obviously we have to limit somehow the two segment of the two side of the interbank market, because this is how banks can take up loans from each other if they need liquidity, and this is when they can put their deposits at the other banks at the interbank market. So when they have excess liquidity, obviously there is a difference between them. So the central bank tries to put it under pressure. So usually they are providing loans at the overnight market, or 1-day loan is provided. And in this case, if you are setting it well, then you can guide this market, or at least you can avoid that there is an increasing spread between the two sides, so you can also limit the spread between them. So the standing facility is also quite popular. Also, if there is any demand for liquidity, sudden demand for liquidity, then you can do a tender. These are absolutely discretionary operations. So in this case, you can say that, okay, sometimes tenders are, so you have a calendar for that, so we know when it happens, but sometimes it can be quick that you have to mitigate the liquidity issue. Outright operations, they are highly popular in the Anglo-Saxon countries. They were. Nowadays it's popular everywhere, because in this case you are buying or selling bonds. For government bonds, as a central bank, you can buy it only on the secondary market, because that would be, if you would buy directly from the state, that would be considered as an illegal monetary financing for the state, which would create inflation. So we cannot do this. On the secondary market, we can buy as much government bonds as we want. For private bonds, so for bonds which are issued by companies or banks, we can even go to the primary market. So when they are issuing it, we can directly buy from them. Question can be that what is happening if the bank is state-owned? Then, if I know well, then in this case you cannot do this. So it will be considered as a part of the state, so you can go only on the secondary market. Yeah. So in this case, you would like to have an impact on the long-term yields. So the motivation behind this is always this one. But the problem that in this case, you will have a portfolio of different bonds. So once in the case of repo, you can say that, okay, how can you have the strategy, to exit strategy. How can you get rid of the bonds? Because sooner or later, your clients should buy them back. In this case, in an outright operation, you will just sit on a lot of bonds, and maybe if you don't need this, you can sell it on the market. Just in this case, you will decrease liquidity. Or you can wait until they are expiring. So in the US Fed, even they are saying that it doesn't matter if you have a lot of government bonds, because practically this will determine the revenue of the central bank. So it doesn't matter at the end of the day until you are realizing interest revenues on this one. What is forgotten from the book, but nowadays they can realize heavily that, okay, if we have a lot of government bonds, so obviously if we were purchasing these government bonds as a price, let's say price 1, but also at the same time interest rates were really close to 0, again because of the simple financial rule that if we have to divide all the cash flows or the revenues from these bonds at really low interest rates, then their price will be really high. So in many cases, the notional or the pair value the price will be close to the pair value, what should be repaid at the when the bond expires. But if we have an inflation shock, so in this case inflation was also really close to 0, but if inflation is happening, so price level increases, then we will have bigger than 0 interest rate, then obviously this will create lower bond prices. So this is drops. And if we have a huge portfolio from different bonds, then obviously we have to re-evaluate their value. And until we are just keeping them on the asset side, this is no problem for us, because we just, okay, it will be an artificial thing that from accounting point of view, we have to do the re-evaluation. So during the next financial year, we have to highlight that we have unrealized losses because of this price decrease. So that's the reason that nowadays all the central banks, doesn't matter, ECB, Hungarian Central Bank, Japanese Central Bank, most of them are in losses because of this price drop in their bond portfolio. Problem will arise when we are using these bonds as collaterals in other actions. This is how investment banks defaulted in many cases during or since the 70s. When we are building up some kind of a portfolio, then for other loans we are using them as a collateral, and when there is a sudden drop in the prices, then if you are not able to withstand or asset sides or assets are also constrained by this drop, then if we cannot raise additional liquidity to maintain this collateral, then we cannot maintain our other derivative or other further positions, and we can go easily to default, even if otherwise the company is working well. So it has its own risks. To mitigate this risk, they introduced haircuts. So it means that if you are selling something to the central bank, they are not buying it at market value. They are always defining this haircut as a percentage of the market value. So sometimes it can be 5%, 3%, sometimes 10% if it's more riskier. Usually for government bonds, the haircut is lower. For private securities, it can be higher. And this is how they are trying to avoid such a situation. Obviously, it was not enough to mitigate the current situation from the last 3 years because of the inflationary pike. And next thing is the mandatory reserve ratio. So in this case, what we can see here is that they are trying to set the mandatory reserves made by the commercial banks at the central bank. So in this case, some part of your assets cannot be lent out to the private sector. Instead, you have to put it mandatorily as a deposit to the commercial to the central bank. In this case, they can limit the liquidity conditions in the market, and yeah, that was under monetary aggregate targeting. The problem is that it's really hard to set these monetary reserves well. So usually what we can see here that they are setting it as 2%, 3%, and then don't care about it at all. So mostly this is a dead instrument. What we can see that in China, this was and still is popular, highly popular, because in their case they have to maintain a fixed exchange rate regime under huge current account surplus, which means that money is always flowing in because they have to maintain this exchange rate regime. Okay, right now it's not fixed, but whatever, so it's fixed like thingy. So stabilized arrangement. So still they have to buy up excessive US dollars and other currencies from the market, and they have to sell Chinese renminbi during this procedure. So it would create a lot of liquidity, and you have to absorb it somehow. So in this case, you can do it by setting the mandatory reserve ratio to higher numbers. So sometimes it was 20%, or sometimes you are not even doing it just with the mandatory reserve ratio, because it would just affect the lending of the commercial banks, but you are also mandatory sale and purchase, mandatory purchase will happen at the commercial banks, that they have to buy bonds issued by the central bank, and they have nothing to do but buy it. So this can also happen, that when you have this need for sterilization for the excess liquidity, but these are really rare cases, or we cannot find much countries which are doing this one. Okay, so now we can go through the central bank instruments, since we have this really simple graph here. So Lombard lending, it means that all these loans are backed by some kind of a security as a collateral. Standing is, I mentioned that already, that it's happening here on the short run. So it's deposits from the central bank, and also, sorry, it's deposits from the commercial banks, and also loans to commercial banks. This is the key policy rate here. These are the standing facilities. And in the case of the bond market, we have the repo and we have the outright transactions. So what we can see that they're supposed to be longer term instruments. Yeah.